All right, welcome back. Let's talk about metrics. These are key performance indicators or OKRs, uh, operational key results or objective key results that we can leverage in order to know that we are on track and use that as our North Star. So, a couple of metrics to think about for traction. There are five key ones. One is the ratio of lifetime value of the customer, LTV, versus or as compared to customer acquisition cost, CAC. So LTV is essentially the gross profit over medium term, 3 to 5 years, based on your current gross margins. That's typically the lifetime value of a customer. If your customers stick around longer than 5 years, then maybe it should be a longer period of time. If they drop off or leak, there's attrition or churn faster than 3 to 5 years, we need to define how long they're going to be a valuable customer. And once we know the value, how much do they buy cumulatively from us? It's a dollar amount. And we compare that to what did it cost us to get that customer in the first place? That's our total marketing and sales costs divided by the number of customers. This should include all costs in, like salaries and other costs, costs of goods sold as well. And if the ratio of LTV to CAC is more than 3x, lots of experts define that as a good metric to know that you can scale, that you are scaling, that you can be successful. If the ratio is less than 3 times, something is missing. Either it's lack of a real value proposition or lack of understanding unmet need, or customer segments are wrong, channels are wrong, the business model is not optimal. So we have to go back to the drawing board until we achieve at least, if not more than, a 3x ratio. We also want to think about monthly recurring revenue, known as MRR, or annual recurring revenue, ARR. This should be growing at a pace that's measured and reasonably strong. So let's say rule of thumb can be at least 10% month over month MOM growth. If we have 10% or higher, we know that we're growing properly. There's not too much churn and attrition to reduce our growth. Speaking of which, we want to make sure the churn or attrition rate is less than 20%, ideally even less than 10% or 5%. But if it's more than 20%, we have a problem. We also need to look at our Net Promoter Score. Try to achieve greater than 30 or higher, which means, let's say on a scale of 0 to 10, how likely is the customer to recommend our solution to someone else they know in their network, friends or family or colleagues or peers. This is important. It's a very simple way to survey customers and say on a scale of 0 to 10, you may have seen it on software applications. When you are done using it, it might ask you how, on a scale of 0 to 10, how likely are you to recommend it, word of mouth, or via social media or reviews or comments, because people do listen to other users' perspective on experience of a solution. And then also sales goals. These 5 key metrics will help you measure that customers are loving your product or not so. And you want to think about marketing campaigns, channels, biz dev efforts, customer referral programs, loyalty programs, in order to maximize the outcomes from these 5 drivers or metrics. Now, if we put it all together, we have the value prop fit, which is the first column, where now the goal of value prop fit is to learn what customers love. Target market are innovators, early adopters, go-to-market process. We ourselves as founders are doing all the selling in order to have a pulse on the market and the customers and to know them and understand them well and be connected to them. We don't really have a sales team yet. We are sales. And then demand generation is through personal networks of the founders and word of mouth referrals from the early adopters. So they're adopting first, and then we worry about pricing. So maybe it's a free pilot or a sample prototype to get it going. Number 2, go-to-market fit. We achieve that when we understand our unit economics per unit. What does it cost? What do we make? What are our gross margins? We've identified our early adopters beyond the innovators, and we're using or leveraging product-led growth. We might have maybe a first representative, someone who's junior, who's fast, helping her with sales. So low cost, fast return on investment. And demand generation comes from experiments through marketing and partner experiments. And pricing, customers will give us feedback loops to develop our initial pricing model. Then we have business model fit, where we're focusing on the goal of growth and creating a moat, a protection, something differentiated, unique selling proposition. So we figure that out. We have our early majority in terms of market segment that we are now targeting. Our process includes leveraging partners and a sales team, so some senior sales folks or biz dev folks. We have a process to train and manage and assess their performance. We use multiple channels that are aligned with our sales strategies and goals and tactics. And our pricing model allows us to have profitable unit metrics so that if we've done it a few times and we pour fuel on our business model, we can scale pretty fast. So let's take a quick look at a series of MVPs from a case study of Rent the Runway. It's an online service that rents designer dresses to women mostly as their customer segment. Co-founders were Jennifer Hyman and Jennifer Fleiss from Harvard. And their tagline is love, wear it, return it. Basically rent fashion at a lower cost than it is to buy. So let's look at their first MVP. The founders borrowed some dresses, invited female undergrad students at Harvard to 2 trunk shows. These are events. So they basically created some form of a focus group and did their customer discovery to test their hypotheses. 125 girls showed up, and about a third of those attendees actually rented the dresses. So what did they learn? Number 1, women are willing to rent previously worn dresses that have been cleaned or fixed, and they would return them on time undamaged. The second thing they learned is which brands, sizes, styles, and colors and price points are the most popular with their early adopters or innovators. These 2 learnings are very useful, which allows them to think about a second MVP. But the problem with the first MVP is that it did not address one key hypothesis. Would customers rent the dresses without touching them, feeling them, or trying them on? Let's assume it's a digital platform, an online platform, and not a live event or a trunk show. Because at a trunk show, they were able to do all of that. But now the second MVP, what they did is a different pivot of their trunk show, where women or customer prospects can view, but they cannot touch or try on the dresses. This gave them a slightly lower percentage of attendees that rented the dresses, but they still learned a lot because they leveraged the learnings from their first MVP and therefore increased the outcomes. The problem is both of these MVPs are still in a social live setting, not a solitary experience, which is more realistic if there were to be a digital platform only. So you guessed it, the third MVP would be to validate demand under more realistic digital conditions. So here they created a PDF, emailed it with pictures and descriptions of the dresses to the women who asked to be notified about the launch by creating a simple landing page. Women can register or sign on, and once they do that, they're notified through the PDF, and they had a 5% rental rate, lower than the previous MVPs, but still sufficient threshold to validate a viable business model. Because if they expanded the market size into different geographies or market segmentations, 5% could lead to a pretty big number. And so these series of MVPs, quick, iterative experiments, low-cost experiments to learn insights, pivot, or validate your business model, you can go pretty far. The last element is the revenue model or pricing model. So there are 8 fundamental core pricing models. The first is unit sales. Basically, a product or service is sold on a per unit basis at a fixed price. Think of a lemonade stand. You can have advertising pricing model where sponsors or affiliates pay for opportunities to distribute their message through your customer target market. There could be a franchise model where a core group of founders sell and support the business model to others to invest in and manage locally their independent owned store. Think of Chick-fil-A or Dunkin' Donuts or fitness gyms like Orange Theory. It could be salons like Moxie, beauty salons. So all of these are franchise models. It could also be on a consumption basis or utility pricing model, pay-per-view, per use, per consumption. It could be a subscription model, which is very popular these days, fixed price for access for a period of time, depending on what level you are at. Maybe it's freemium, the base model is free, and then you get advanced features, more usability, or utilization based on premium, recurring revenue. Next could be a transaction fee based on referring or executing. Think about PayPal, Kickstarter, Airbnb, or even the real estate brokers model. There could be professional fees, time and material contracts, consulting on top of a product sale, implementation, maintenance, things like that. There could be licensing or royalty fees, the right to use, the right to brand, co-brand. Think about merchandising, sports, entertainment, industries. Think about fixed price, where there's a cost and a markup. A value price, so different customer segments pay a different value or price for the value. It could be based on features or just customers. So you can discriminate here. It could be volume pricing based on quantity or bundling of different products or services or how frequently they buy. Or it could be random to test different pricing models, seasonal or with discounts and promotions. Then there's also dynamic pricing, which could be more negotiated agreements or yield management, meaning that revenue management, you need to yield a certain result. So everything is marked up by the same percentage, like 2%, like a Costco model, or hotels that will change their pricing to make sure they get a certain amount of occupancy per night, or airlines change the price of every seat in real time in order to maximize utilization of the aircraft and revenue and profitability. Could be auctions, normal live auctions, silent auctions, Dutch auctions, reverse auctions, with or without reserves. It could also be real-time market pricing, which could lead to surge pricing like Ubers during heavy usage if there's large events. and lower the price if the demand goes lower. So know your key assumptions, what needs to be true for you to win, understand how to de-risk your value proposition, tell a compelling story, articulate your business model, and make sure someone on the team is really great and exceptional at selling all the time, from the early moment all the way later as you grow and scale. So in the next module, we'll talk about some examples of business models, 33 frameworks that you can leverage combinations and permutations to create even more unique or new business models in the process.